Good morning, all. In today's session, we are going to see all the different sources of finance available to a company for financing its capital requirement. So, understand, student, in today's lecture, we are going to see advantages and limitations of all of the sources which may be known to you. That includes equity share capital, preference share capital, debenture capital. Okay, so basically here we'll be talking about the long-term sources of finance. By long-term sources of finance, we mean when company requires different assets and the property to establish the business or to modernize or reorganize the business, company requires large amount of funds, mainly lakhs and crores of rupees company may require to finance such requirement. अगर बिजनेस आप शुरू कर रहे हो तो अंडरस्टैंड बिजनेस शुरू करते टाइम पे यू विल हैव टू बाय मशीनरी लैंड प्लांट बिल्डिंग एंड फॉर ऑल दिस रीजन आपको पैसे लगने वाले तो अंडरस्टैंड once you buy machine you won't be buying it every now and that's the reason why it is called as a long term capital requirement, and the way we finance it, it's called as long term sources of finance. Since we know there are multiple sources available to a company, understand each source has its own advantages and disadvantages, which will sum up at the end of the session. So there are different sources. They are classified based on different parameters. Basically, they are categorized on the basis of time, like short-term sources, medium-term sources, and the long-term sources. Based on ownership, the people, owners, that is the shareholders of the business who contributes. Normally, the contribution generated from the business is considered as the owned sources, or even the contribution of the shareholders is considered as the own sources, whereas any contribution received from outside the company in the form of issue of debentures or maybe term loan, that is termed as borrowed sources of finance. Now, how the funds are generated, that will help you categorize the sources of finance into internal and external. So basically, internal sources are the sources which are generated from the company, and outside sources are the sources where we generate the funds from outside. Try and understand, this is the most important categorization of the sources, where own sources include share capital, that is equity share capital as well as preference share capital, and also the retained earnings, which is part of the profits retained in the business. Whereas borrowed sources covers all the sources which we generate from outside the company. One of the sources, the debentures, where like shares, we distribute debentures, and those people who bought debentures becomes debenture holders. They contribute as a creditor, okay, or as the third person or external person to the company. Now, there are different types of loans. Out of them, if you talk about only long-term sources, we refer to term loan here, the loan which is taken for a long time duration. Then public deposits, it's a short-term source of finance. Internal sources are also called as or termed as plugging back of profits. You may have seen what farmers do is they sow the seeds, and then whatever grains that they get, they may either sell it into the market or consume it, or they can use that as a seed again to grow more crops in future. Now, similarly, if company is earning profit, company may decide to invest that profit again into the business so that in future that is going to grow. So which includes reserves and surplus, sale of asset. Now see, when you're buying a new property, new machine, building anything, now maybe earlier ones you are going to sell it out since that has become outdated. So then some amount of funds you're going to receive, that may be termed as sale of assets here. And the retained earnings. Now, ideally, understand if company is earning profit, company is supposed to pay it in the form of dividend to the shareholders. But if company has some reasons, some amount of spending to be done in, then company may decide to retain, to keep this profit into the business. If company retains that profit, now that is going to be there forever into the business. Now, based on the time, long-term and the short-term sources, this categorization is given. Long-term sources includes your shares, equity and preference shares. debentures, and the term loan. And short-term sources include lot many sources where normally advances from the commercial banks, you can take some amount of an advance, then public deposits, and even if you delay the payments for some time, you will not have to make the payment. So that money you can use it for some other purpose. That's the reason why even delay in payment is considered as the one of the sources. How you will determine which sources to be selected when you have so many sources? So there are a lot many things based on which you will select. Now, period of finance, whether you require it for just 1 year, 4 years, 5 years, or you require it for at least 10 years. So understand, if you are buying machinery, lakhs and crores of rupees will be required, and it will definitely be so much difficult for you to pay it within shorter time. So normally, period of finance will be the long term or long time duration for such requirement. Now, cost of funds. Now, if you compare all these sources together, you will realize equity share capital is the most costly source, whereas loan funds are comparatively less costly or having low cost for the company. So, based on that cost, if you'll see, company prefers borrowed funds, but since risk is quite high with the borrowed funds, company restricts its proportion. So the next is the amount of finance required. If it is very small amount, you can easily repay within short time. So you will prefer short-term sources. But if it is a big amount required for buying some machine or plant, then definitely you require more time for making the payment. Then long-term sources will be preferred. Then availability of capital markets. So again, how easier it is for the company to get funds from the market. Okay, that also matters. If it is easy, then company can be issuing shares, debentures, and then generating funds. Shareholders' expectations. Now, what shareholders expect, if they want immediate returns or they are ready to wait for future growth? Trading on equity. Now, this benefit refers to use of borrowed funds for maximizing your earning per share. Now, when you use more and more borrowed funds, you get two benefits. One benefit in the form of cost saving, since we have seen borrowed funds are less costly. And the second benefit in the form of tax saving. So if you're using borrowed funds like debentures and term loan, your interest which you paid on these sources is a tax deductible expense. So what happens? Your profit will be reduced by that much amount, whatever interest you pay, and then on remaining amount we pay the taxes. So definitely, if you have borrowed sources, you will be paying less amount of a taxes. This is how tax saving will be helpful to you to generate additional earnings for the company or for the shareholders. That is referred to as trading on equity here. So risk, as I said, borrowed sources are more risky, own sources are less risky since the payment obligation is high. Government rules and regulations with respect to how much amount of borrowed funds you can have and market conditions that will define which source you're going to choose. Now we'll see in detail the sources available to the company in short. So we'll see the benefits and the limitations of each of the sources. So to start with, we'll see equity share capital. Now if you'll see company share capital, if it is divided into small equitable units, which have equal value, that is called as a share. Now the people who buy the shares becomes shareholder. So they contribute towards the capital of the company. So basically they are indirectly the owners of the company. Now for contributing towards equity share capital, the benefits which they get we'll see, and also the features of this source. So main features are it provides you ownership rights since you're contributing towards the capital of the company. Second thing, we know all these shares are transferable using stock exchanges. You can buy and sell the shares if you don't want it. Okay, so they are transferable. For company, it's a permanent capital because once company issues the shares, company would be making repayment for the same. So company just issues the shares, people buy it, and then from one investor to the other investors, they get transferred. So for company, it's a permanent capital. company will not have to make repayment unless it's buyback of shares, which is very rare condition. So company is going to pay dividend for this share capital. So understand, if company is issuing shares to the people and people buy those shares, they pay for it. That's how company gets the funds. And for using this money, as and when company earns the profit, company's management will decide to make the payment of dividend to the shareholders for having faith into the company and investing into the capital of the company. So basically, this is the return that the shareholders get. So company has limited liability. As we already know, company's liability is limited to the extent of the contribution of that person into the business. So you may have seen share has face value also, and shares have market value also, because when shares are issued, they may be issued or they may be recorded at the face value, whereas its market value keeps on increasing or decreasing based on its performance into the market or demand and supply of their shares into the market. So basically, this people gets voting right. They can claim the profits of the company, and that's how they get the dividend if company earns profit. They can claim on the assets in the case company gets liquidated. Okay, so they are going to receive the amount of the money, surplus money, I mean. So if all the payments are done and any surplus is left, then they are supposed to receive that surplus. They get additional rights in the sense, if company is issuing new shares, so first preference is given to the existing shareholders, that is referred to as the right share here. So right to control the management. Now understand how the shareholders are going to control the management of the company by exercising their voting rights, by deciding the appointment of the directors, who is to be selected and who is not. Okay. So first of all, we'll see advantages and the disadvantages or limitations of this share capital for the shareholders. Now understand, though from the company's point of view, this is the least risky source. There's no risk at all, since company will not have to make any repayment. Even if company doesn't pay any dividend, there's no legal action that anyone can have against company. To understand, from company's point of view, it is not at all risky, but from the point of view for shareholders, if you'll see, main advantages is that they get voting rights. Second, if they don't want those shares, they can transfer it by selling it to the other people using the stock exchanges. Then they get high amount of a dividend if company earns profit and company is not having any other requirement. In that case, company may distribute dividend. If earning per share increases, they are going to mainly get benefited because of the same. So if you'll see mainly the disadvantages, principal amount repayment failure. Now, in case company closes down and while making the repayments of the liabilities, if nothing is left, then shareholders may not receive any payment for the contribution that they did towards the capital. So dilution of ownership, as you may have seen sometimes, that if company issues more shares into the market, the amount of the contribution that you had towards the capital will reduce since new shares are into the market. Uncertain returns. So there's no guarantee that you will get any fixed returns. Returns are going to vary. 1 year you may get more, 1 year you may get less, 1 year you may not get anything. If there is any fall in the EPS, shareholders are the one who are going to suffer most. Now we'll see advantages and limitations for the company. So first, as we said, it's a permanent capital. Company will not have to make any repayment. Second, there's no dividend burden obligation for the company to pay. No charges on the assets. And lastly, you can understand, for generating large amount of funds for making fixed capital investment, equity is the most preferred option. Mainly if you see the disadvantages for the company, heavy cost, since in the form of dividend, company pays lot much. Second, there's no trading on equity benefit. Since dividend are entirely taxable, you don't get any tax benefit. Fear of transfer of control is one more disadvantage. If one of the person purposefully keeps on buying that company's share and he buys more than 50% of the share, he is going to have major control over the company's functions. Then again, it depends on availability of the capital market, how easily company can raise the funds. Sometimes this is a good option, but even if company issues the share, sometimes company may not get the expected response from the market. Now the next source is preference share capital. Understand equity and preference share capital is very similar. There is a bit of a difference though. Now equity shares are also called as ordinary shares, whereas preference shares are called as a preference shares purposefully. The reason being that they get preference when it comes to payment. Now, as and when company makes payment for the share capital, understand preference shareholders will always get preference. Okay, means their claims will be paid first, and then equity shareholders' claims will be settled. That's the reason why they are called as preference shareholders. Now they get preference while company is making payment of dividend, and they get preference when company is getting liquidated and the repayment is done. So understand it's a hybrid form. It's a combination of own and the borrowed sources because on this source, company pays dividend. Okay, so that is paid on the own sources. But the rate of dividend is fixed like you paid for the borrowed sources. That's the reason why it's a hybrid form of security. Now it gives ownership right to the holders and company pays fixed dividend on this security. Preference shareholders gets preference when company makes payment of dividend. Okay, and at the same time when company gets liquidated, they also get preference with respect to capital repayment. It can be medium or long-term source depending on the type. If it is irredeemable preference shares, then definitely it will be long-term source. And if it is redeemable, so redeemable means after some point of a time, they are going to get redeemed. That's the reason why they are called as medium-term source. Okay. So there are different types of preference shares giving you multiple benefits. You can see the main features. Number one, claim on the income, like equity shareholders get. Claim on assets, like equity shareholders get. Voting rights, but this is not going to be the general voting rights. Only in case of contingency, they get the voting rights. There's no tax benefit on payment of dividend as we already discussed. It can be medium or long term depending on the type of the preference. There's no risk of insolvency since repayment is not compulsory for the company. Let us have a look at advantages and disadvantages of this source to the company and for the shareholders. So first of all, for the company, it can be medium or long-term source. Okay, there's no dividend burden. For the company, there's no risk of insolvency, means obligation is not going to increase or not going to be compulsory. So there's no charge on offset which is created. For borrowed sources, charge on the assets is created. No dilution of ownership. Even if company issues new preference shares, ownership won't get diluted. Main disadvantages to the companies, it is having moderate cost. There are no tax deductions as we discussed, and payment of dividend will be the cost for the company. Normally, though we say for company it is not compulsory to pay dividend, but you can definitely see if company won't pay dividend, even if it earns profit, that is not going to be good for the company since it will impact company's image into the market. Now let us have a look at the advantages to the shareholders. Now see, a fixed percentage of dividend that they get is the advantage, but even if company earns lot much, they will be getting only fixed percentage, and that's the reason why that is also a disadvantage mentioned here. Now understand preference they get while payment. If company doesn't pay dividend for more years, then they also have a right to nominate the person on the board. So main disadvantages to the shareholders is number one, they don't get any voting rights. Repayment may happen in future. Now there are different types of preference shares. So cumulative, non-cumulative. Understand cumulative. Cumulative frequency you may have calculated. Cumulative means it will keep on getting added. Means if company doesn't pay dividend this year and company decides to pay dividend next year, company will be paying dividend for this year and next year also. So मतलब company अगर dividend नहीं pay कर रहा है तो then dividend payment will keep on getting added up. तो एक साथ कंपनी को 2-3 साल का जो भी डिविडेंड पेमेंट बाकी है वो करना पड़ेगा. Such kind of shares refers to as the cumulative shares. Non-cumulative shares, where such provision doesn't exist, means company will pay dividend only for that year. If company doesn't pay this year, means company will be paying only for the next year and not for this year. Okay. So redeemable and irredeemable. So redeemable means after a certain point of time, they'll get redeemed into cash. So we have seen redeemable coupons. That coupon get converted into cash, right? Very similar to it. The shares will get converted into cash. Company will make payment for the same, and that shares will go again back to the company. Participating and non-participating shares here, depending on whether the shareholders will be participating into the profits of the company or not participating. Normally, non-participating shares will see more. Convertible and non-convertible. Now understand, after some point of a time, this preference share may get converted into equity. If such provision is available, then those are the convertible shares. And if such provisions is not there, then now those are non-convertible shares. Now about the profits, understand the profit which the company generates is internal source. So it is nothing but the profit which is not distributed to the shareholders is going to get reflected into reserves and surplus.